Investing is simply putting your money to work to grow over time. It's about making your savings productive, so that every dollar you set aside today has the potential to multiply in the future. Instead of letting your money sit idle, you're giving it a job, helping it earn more money for you, even while you sleep. This is the foundation of building wealth, and it's accessible to anyone willing to take the first step. It's not a game of chance, but a disciplined plan for a secure financial future. Successful investing isn't about luck or gambling. It's about making thoughtful decisions, sticking to a plan, and letting time do the heavy lifting. By consistently following a strategy, you can weather market ups and downs and steadily move closer to your goals. The key is to own a piece of the economy, letting your capital participate in growth and innovation. When you invest, you're not just buying stocks or funds, you're becoming a part owner in businesses that drive progress, create jobs, and shape the future. As these companies grow and succeed, so does your investment. Many are intimidated by finance, thinking it requires genius or secret knowledge, but that's a myth. The world of investing can seem complex, filled with jargon and fast-paced news, but the truth is you don't need a finance degree or insider tips to succeed. Ordinary people from all walks of life have built wealth by following simple, proven principles. The most effective strategies are straightforward, built on common sense and discipline. Automating your savings, investing regularly, and staying the course are far more powerful than chasing the latest trends or trying to time the market. Consistency and patience are your greatest allies. Over time, even small, regular investments can add up to significant wealth. The magic of compounding means your money earns returns, and then those returns earn even more returns. This snowball effect is how fortunes are quietly built, one step at a time. My core message: the average investor can achieve great results by following a simple strategy, buying the entire market and holding it long-term. You don't need to pick winning stocks or predict the next big thing. By owning a broad slice of the market, you benefit from the collective growth of thousands of companies. Don't try to outsmart the market. Instead, buy the whole haystack, not just search for the needle. Chasing hot tips or trying to find the next superstar stock is risky and rarely pays off. Instead, focus on owning everything, so you never miss out on the winners. We'll explore index funds, how they work, and why they're the best choice for most investors. Index funds are simple, low cost, and designed to match the market's performance, making them a powerful tool for anyone looking to build wealth steadily and reliably. You don't need to be a Wall Street expert, just have a sound plan and the discipline to stick with it. With patience, consistency, and a focus on the long term, anyone can follow this simple path to financial freedom. Imagine the stock market as a massive, delicious pie sitting right in the center of a bustling bakery. Each slice of this pie represents a different company, big or small, famous or lesser known, all working together to make up the whole. Some slices are huge, like Apple or Microsoft, while others are much smaller, but every single one is a part of the complete pie. When you look at the pie, you might be tempted to pick out the biggest, most appetizing slice, hoping it will taste the best. That's what stock pickers do. They try to guess which company will outperform all the others. But just like with pie, it's hard to know which slice will be the tastiest until you've tried them all. The truth is, even experts often struggle to consistently pick the winning slice. Sometimes the most promising-looking piece turns out to be disappointing, while a plain-looking one surprises everyone. The market is unpredictable, and guessing right is tougher than it seems. That's where index funds come in. Instead of betting everything on one slice, an index fund lets you own a tiny sliver of every single piece. You don't have to choose. You get a taste of the entire pie, from the biggest companies to the smallest. An index fund holds all the stocks in a market index, like the S&P 500, and mirrors its performance. This means your investment grows and shrinks with the overall market, not just one company's fortunes. By spreading your investment across hundreds or even thousands of companies, you're not putting all your eggs in one basket. You're participating in the collective success of the entire market. The fund manager's job isn't to outsmart the market or make risky bets. Instead, they simply track the index, making sure your investment matches the market's performance as closely as possible. This rules-based approach takes the guesswork and emotion out of investing. It also keeps costs low, since there's no need for expensive research or constant trading. When you invest in an index fund, you instantly become a part owner of a vast range of companies, from tech giants to local businesses, all working to grow and innovate. Instead of betting on a single company's future, You're betting on the long-term progress of the entire economy. As businesses grow, innovate, and adapt, your investment grows with them. This is broad participation, not narrow speculation. You're joining millions of other investors in sharing the rewards of economic growth, and that's the beauty of index funds. A simple, stress-free way to invest in the market's collective success, giving you peace of mind and a solid foundation for your financial future. Let's look at some real-world examples to see how different index funds can help you build a strong investment portfolio, no matter your goals or experience level. The S&P 500 Index Fund is one of the most popular ways to invest in the stock market. It lets you own a small piece of 500 of the largest and most influential US companies. Think Apple, Amazon, Google, and many more. When you invest in the S&P 500, you're not just betting on a single company's success. Instead, you're spreading your investment across a wide range of industries, from technology and healthcare to finance and consumer goods. This fund is a direct investment in the American economy and is often used as a benchmark for how the overall market is performing. Many investors use the S&P 500 as a core part of their portfolios because of its long history of growth and stability. XEQT, on the other hand, is an all-in-one fund designed for those who want instant global exposure. With XEQT, you're not just investing in the US, you're also getting access to companies in Canada, Europe, Asia, and emerging markets. This means your money is working for you all over the world, helping you benefit from growth in different regions and industries. XEQT is perfect for investors who want broad diversification without having to pick and manage multiple funds. It's a simple, one-stop solution for building a globally balanced portfolio, making it easier to weather ups and downs in any single market. VDY, by contrast, focuses specifically on Canadian companies that pay high dividends. This fund is ideal for those who want to receive regular income from their investments, such as retirees or anyone looking to supplement their cash flow. By investing in VDY, you're supporting Canadian businesses while earning steady payouts. Each of these funds serves a unique purpose: SP 500 for US growth, XEQT for global reach, and VDY for reliable income. You can choose one or combine them to match your personal financial goals and risk tolerance. All of these funds track an index, which means they follow a set list of companies and don't require constant buying and selling. This makes investing simple, efficient, and often more affordable than actively managed funds. The key is to choose the fund or mix of funds that best matches your investment goals, time horizon, and comfort with risk. You can always consult a financial advisor if you're unsure where to start. Whether you're aiming for long-term growth, global diversification, or steady income, there's an index fund out there that fits your needs and helps you move closer to your financial milestones. Remember, simplicity and clarity are at the heart of these choices, making it easier for anyone to start investing and stay on track for the future. Investing means choosing between picking individual stocks, the manager's game, or owning index funds, the owner's game. The manager's game is about trying to outsmart the market, but most who try end up losing. Even professionals rarely beat the market over time, and the risks are high. The owner's game is about buying the whole market through index funds and holding for the long term. You don't need to be right twice, just buy and hold. This approach removes stress and emotion, tying your success to the economy's growth. Stock pickers chase needles. Index investors own the haystack. The owner's game is about discipline, low costs, and reliable results. It's common sense over speculation. Choose to be an owner, not a gambler. Index funds offer unbeatable advantages. First, diversification. Your money is spread across hundreds or thousands of companies, reducing risk. Second, low costs. Index funds have minimal fees, so more of your returns stay with you. Over time, high fees can devastate your wealth, but index funds keep costs tiny. Third, tax efficiency. Index funds buy and hold, triggering fewer taxable events. This lets your investments grow more efficiently. Finally, simplicity. You don't have to chase trends or worry about daily market moves. Just buy, hold, and let compounding work. Simplicity isn't naive, it's smart, disciplined investing. That's why index funds win. No investment is risk-free, including index funds. The main risk is market risk. When the whole market drops, so does your fund. That's the price for long-term growth. Index funds are best for money you won't need soon. Short-term needs belong elsewhere. The real power comes from holding for decades, not months. Don't panic during downturns. Selling at the wrong time is the biggest mistake. Index funds won't beat the market, but they won't lag far behind either. You trade the chance for huge wins for the near certainty of steady growth. Tracking error is minor in reputable funds. Your best defense is time in the market, not timing the market. Starting with index funds is easier than you think. Open an account with a discount brokerage. Online platforms like Erode, Wealthsimple, Vanguard, or Fidelity. Fund your account by transferring money from your bank. Choose the right account type, TFSA or RRSP in Canada, Roth IRA or 401k in the US, to maximize tax benefits. Search for your chosen index fund by its ticker symbol like VFV, VOO, or XEQT. Place a buy order for the number of shares or dollar amount you want. With a few clicks, you own a diversified portfolio. Make investing a habit. Set up automatic, recurring contributions. This dollar-cost averaging approach builds your wealth steadily and removes emotion. Don't worry about timing, just invest regularly and let compounding do the work. Consistency is your greatest ally. Fees are the silent killer of investment returns. Every dollar paid in fees is a dollar lost forever. Even a small annual fee compounded over decades can slash your wealth. For example, a low-cost index fund can leave you with tens of thousands more than a high-fee active fund after 30 years. High fees, sales loads, and commissions are hurdles most managers can't overcome. The best way to boost your returns is to minimize costs. Choose low-cost index funds and keep more of what you earn. Don't be tempted by promises of market-beating performance from expensive managers. The math is simple. Lower costs mean higher wealth. The path to wealth is simple. Own the market through low-cost index funds. You don't need special knowledge or risky bets, just discipline and common sense. Index funds give you instant diversification and reduce the risk of betting on a single company. Minimizing costs is crucial. Fees can erode your returns, but index funds keep them low. The evidence is clear. Passive, index-based investing outperforms most active strategies. Open a low-cost account, use tax-advantaged plans, and invest regularly in broad market funds. Hold for the long term, ignoring market noise and trends. This steady, disciplined approach is the surest way to build wealth. Stay the course.